For over a decade, a Bitcoin ETF, well, it felt like a total pipe dream, right? It was this constant battle between the crypto world and some very skeptical regulators. But then, in 2024, it actually happened. Thing is, this isn't just a simple story about winning. No, this is the story of a hard-won and frankly brutal compromise. So that brings us to the big question. How? After 10 years of getting shut down again and again, what finally kicked the door open for Bitcoin on Wall Street? Let's get into it. You see, the breakthrough wasn't some kind of aha moment where regulators suddenly got on board with how crypto works. Not at all. It was something way more strategic, and for a lot of crypto purists, way more controversial. The answer, and this really is the key to the whole thing, was what our source material calls a brutal structural compromise. To get a seat at the big table, Bitcoin couldn't just show up as itself. It had to be reshaped, repackaged in a way that Wall Street could actually handle and, control. This is the story of that compromise. It all goes back to this decade-long siege. For years, big asset managers were trying to get a Bitcoin ETF approved. And for years, the SEC, led by a very careful Gary Gensler, just kept saying no. They were worried about market manipulation, investor protection, the whole shebang. It was a real game of cat and mouse. And right at the heart of this entire fight were two totally different ways to build an ETF. And believe me, the choice between them wasn't just some tiny technical detail. It was everything. It was the entire battlefield. Okay, so this lays out the core conflict perfectly. On one side, you've got the in-kind model. This is how most ETFs work. It's clean, it's efficient. A big authorized firm, an AP, literally just hands over the asset, in this case Bitcoin, and gets ETF shares in return. Simple. But the SEC drew a line in the sand. They mandated the model on the right, cash creates. Now with this model, the big Wall Street players could only hand over cash, good old US dollars. This forced the ETF issuer, someone like BlackRock, to then go out and do the messy work of buying the actual Bitcoin themselves. So why? Why did the SEC force this clunkier cash model on everyone? Well, it really boiled down to three main fears. First, they just did not want big regulated banks like JP Morgan or Jane Street getting their hands dirty and directly handling Bitcoin. Second, they were worried about all the anti-money laundering and know your customer rules, AML/KYC. Could these firms really track the history of every single coin? And finally, there's this regulatory perimeter. A lot of these banks are just not allowed to hold crypto on their balance sheets. So the cash-only model was basically a clever workaround for all of these problems. So what this compromise created was this really complex financial machine. Let's pull back the curtain and look at the mechanical ballet that's happening every single day behind the scenes. First up, let's look at what happens when everybody and their brother wants to buy the ETF. This is called the creation sequence, and it gets triggered whenever investor demand just goes through the roof. Okay, so it all kicks off when an authorized participant, an AP, sees all this demand and sends a huge pile of cash over to the ETF issuer, let's say BlackRock. BlackRock then has to immediately turn around, take that cash to a crypto exchange, and buy the Bitcoin. That Bitcoin then gets whisked away and locked down in a super secure, offline, cold vault. It's only after the Bitcoin is safe and sound that BlackRock creates brand new ETF shares and gives them to the AP, who can then sell them on the stock market to all those eager investors. So what happens when people start selling? Well, you just throw the whole machine in reverse. This is the redemption sequence, and it happens when demand for the ETF starts to dry up. So this time, the AP goes out and buys up the ETF shares from the stock market and hands them back to BlackRock, basically to be destroyed. BlackRock, in turn, sells the exact same value of Bitcoin from its vault and turns it back into cash. And finally, that cash gets sent back to the AP and the cycle is complete. It's just this constant, delicate balancing act between cash, Bitcoin, and ETF shares. Now look, this cash-only model, it works, but it is far from perfect. That brutal compromise we talked about, it came with some very real costs and hidden risks baked right into its DNA. So, the first big one is something called slippage. Just think about it for a second. There's a delay, right? A gap in time between when BlackRock gets the cash and when it can actually execute the Bitcoin trade. And in a market as wild as crypto, the price can move a lot in just a few seconds. That little price difference, that's slippage. And it's a risk that the fund itself, and by extension, you, the investor, has to eat. And that slippage, it leads directly to this next problem, tracking error. This is the risk that the price of the ETF doesn't perfectly match the real-time spot price of Bitcoin.
Over time, all those little moments of slippage, plus the fees, can cause the fund's performance to drift slightly away from the asset it's supposed to be tracking. The bottom line is, this cash model introduces a layer of friction that the much cleaner in-kind model just doesn't have.
Okay, so if this design has all these little imperfections baked in, why on earth was the Bitcoin ETF one of the most successful product launches in the history of finance? Well, the answer is a really fascinating paradox. It all came down to a powerful force called the liquidity flywheel. BlackRock's ETF IBIT had such insane trading volume right from day one that it created these incredibly tight bid-ask spreads. That's just the tiny gap between the buy and sell price. Because the gap was so small, it became the cheapest and easiest Bitcoin ETF to trade. And what did that do? It attracted even more volume, which made the spreads even tighter. You see, it's this powerful self-feeding loop that just completely steamrolled the competition. At the end of the day, the compromise was absolutely worth the price of admission. For the first time, wealth managers could buy Bitcoin for their clients just like they buy shares of Apple or Tesla. Same screens, same brokerage accounts, no new infrastructure needed. And maybe most importantly, it wiped out the anxiety of self-custody. No more worrying about private keys, hardware wallets, or any of that. It just worked. The source material really hits the nail on the head with this quote. Through all these mechanics, the cash create model, the ETF wrapper, the custody, Wall Street didn't just accept Bitcoin, it found a way to take this wild, decentralized, untamed asset and, well, it domesticated it, making it fit neatly inside its own regulated, centralized world. And that leaves us with one last massive question. Is this whole domestication thing just a temporary bridge? A stepping stone until regulators finally get comfortable with crypto in its native form? Or have we just seen the final form that all digital assets will have to take if they ever want to be accepted by mainstream finance? The answer to that is going to define the future of this entire space.